So I think in the best of circumstances, most people view finance as dry and soulless, and those views are exacerbated when a finance panel precedes a break. So we're going to try to keep this interesting. And I think since almost everyone knows in the audience knows us, let's just get right into it, and hopefully we'll have a good discussion. During our prep, Marsha asked a great question, which was foundational, which is basically why take out construction financing? And I think that boils down to two questions. Why do the super rich need money to begin with? And secondly, who's crazy enough to finance non-commercial assets that have long build times and no commercial purpose once they're built? So I think let's start there, and Marsha, perhaps from a builder's perspective, what do you get out of construction financing?
I think for us as a builder, it's we don't deal with it that much actually in the sector that we as Feadship are in, but we sometimes see finance come in, let's say about 1/3 of the build, and it feels more like the opportunity costs of money for the clients is the reason why they do it. It doesn't have anything to do with the build itself. So it's an interesting one for us because it affects us to a certain point, but on the other hand, our clients don't need the finance. So there have to be other reasons that they do finance the boat. And I think that's more where the gentlemen here are in the experience level, because for us it's interesting to see. I think looking back over the past 10, 15 years, I think I've maybe seen one client on our side who said, I need finance to actually finance the boat, who doesn't have the liquidity or the net worth to do so. All the other clients do. Now, I'm speaking for, on average, the 50, 60 meter plus clients. So I can't speak for the 24 meters and up, where it perhaps is a different situation. So I don't know, gentlemen, what size brackets do you, on average, finance or deal with?
Yeah.
Yeah, thanks. Well, I think there are some distinct markets here that I think you've probably got your 30 meter, probably up to the sort of 60.
I can't hear it. It's not the comments.
Can you hear me? Better? No?
Test.
We're not working.
Mine works.
Try again. Is that better? Okay. So I think you're looking at really a couple of distinct markets here. You've got No? Yes. I'm just not talking loud enough. Let's try again. So for the third time. There are a couple of distinctive markets here. There's really a kind of 30 meter where the super yacht typically starts up to sort of 60 or 70 meter. And then we've really got your larger yachts beyond that, which I think is what your main experience is. And you, understandably, you have different clients in those distinct markets. Very much at the top end, which is an area these days that we, as an arranger, see most of the demand. It's much more in the sort of 30 to 60 meter. Now, even in that area, most clients have the necessary means and liquidity to be able to fund a new construction. They choose not to. Why do they choose not to? Well, it's that opportunity cost of capital that they have. Some data that I've seen recently about how ultra high net worths actually invest. Around about 25% of their investments is in kind of more riskier private equity. The sort of returns that they're looking for on those type of investments is around about 15 to 25% annual returns. So you think about that, will a client sort of sell those assets, those investments to provide liquidity to pay a number of milestone payments for a yacht over 3 or 4 years doesn't sound overly attractive for those clients when they can make a significant better return elsewhere. I think at the top end, you tend to be looking at a slightly different client, probably more experience, obviously much more wealth. But I think the same reasons still apply. But I think that they're much more focused on optimization of their capital. I think that's probably to pass to my private bank colleague to the right here, who'll probably talk a little bit more about the kind of larger end of the market.
Yeah. Uh-oh. Now it's my turn. Not working? Try that one. Hello? Oh, there we go. So I would agree. I think ultimately, we're working with our clients, to facilitate their long-term objectives, which involves liquidity planning. And so I think most of the financing we are doing when it comes to yachts in general, but in particular yacht construction, is on the larger end. But that's not because we have more appetite for the large end of the yacht space. It's simply that there are more levers for a client to pull, for a smaller yacht. So if we're talking about a 200 million euro build, you're going to have a much bigger conversation about liquidity and what are the consequences if you access that liquidity from elsewhere on your balance sheet versus utilizing the bank, as opposed to if you're doing a 10 million euro build, accessing 5 to 10 million from a balance sheet is there's going to be a lot more options that are probably in many cases more convenient than putting in a structured yacht construction financing.
Okay. And from the legal perspective,
Well, I have a microphone that works. So I love construction financing as a yacht lawyer. It's exciting because it's multiple parties coming together. I mean, you're essentially underwriting the lender. I represent a number of lenders. They're underwriting the business, right? They're essentially entering into the shoes of the borrower if something should go wrong. So your lenders, you need to look at they need to look at the shipyard. They need to look at where the shipyard is located. They need to look at the kind of collateral that the borrowers negotiated for the build. Are there refund guarantees? In which case, the question then is, which bank, the builder's bank, is issuing the guarantees, and are those guarantees acceptable to the borrower's bank? You also have the builder's insurance policy, which for those of you who don't know, I live in Puerto Vallarta, Mexico, and so it was a very exciting week with several yachts that were very near to some danger. So you look at the insurance there. Where is how is the builder's risk structured, and what is it covered? So it's a very interesting construction finance with a number of moving parts that all need to be considered and negotiated.
and Panos?
Yeah, sorry. The other interesting thing, I think, from my perspective, I agree with those comments from Chris. It is interesting because you're bringing three parties together, bank, builder, and buyer, borrower. The other interesting thing is the timing consideration. Picking up on Marsha's comment, very rarely, I can't think of an instance we've had where finance was actually part of the first discussion. Finance almost invariably comes later. The starting point, as we said, is that the owner is choosing to borrow. He doesn't need to borrow. You wouldn't be building one of these if you needed to borrow. I think that's true within any part of the market. But because the buyer's bank comes in later, it does mean that for us, the challenges can be trying to bring three parties together with an existing contractual framework between the buyer and the builder, that the bank is then coming in and trying to secure itself against. Now, the reality is that, most of the contracts we advise on, we're always going to look to make sure they are broadly speaking, bankable. There will be a few things that you need to do to make sure that a lender, if you bring a lender to the table, can secure themselves against it. But the challenging bit is always the detail of those things. Chris touched on insurance, the nature of the security, the collateral that the buyer has. I would say in our industry, probably refund guarantees are the exception rather than the rule. A lot of projects have 1 or 2 refund guarantees and then the buyer gets title. Other projects do have full refund guarantees, but once the buyer's primary collateral is title to the hull under construction, that's where you have to mesh all of those. I won't call them competing interests, but you have to reconcile those 3 positions against the hull. Everyone has a common interest in the hull. That's the challenge for us.
And how important is that if the financing is more of an accommodation, a service to help manage liquidity? Like, from a legal perspective and then as a practical matter for the banks?
Yeah, I mean, it does affect I wouldn't say it affects the approach to the discussion. Inevitably, there is a discussion because from the builder's perspective, and I'd like to hear from Marsha on this, to some extent they feel, well, we have our buyer who is performing. It's not that we don't want the bank, but there is a slight feeling of, well, this is already working perfectly well, and we now have to accommodate this request. But at the end of the day, I think, most builders, all builders at the end of the day are also keen to keep their customer happy. And there is something, and I think Steve might comment on this, there is something to be said for bringing a bank in. It does, in a sense, not shore up, but it solidifies a lot of the contractual arrangements. And done correctly, it can actually bring additional security for everyone at the table. Again, it's not starting from the premise that the buyer doesn't have the money. The buyer invariably does have the money, but the bank will bring something else, a level of rigor to the finance side, the way installments get invoiced and paid, and done properly. The bank is hopefully partnering with you and isn't just a source of liquidity. They should be doing a bit more.
Or aggravation.
Or aggravation, but maybe that's for Marsha or for Steve to comment on.
I think what you're saying is, there we go again. Yeah, there we go. What you're saying, it is a service often, and it is an accommodation of the client because the necessity isn't there, but it is, you want to keep your client happy, you want to make sure that the build is an enjoyment in itself. They'll want the financing, as I said, about 1/3 into a build, we sometimes get the financing. What we do have as a yard is that we have standard texts in our contracts on financing. So if the lawyers have an inkling that there will be financing or want to actually keep the option open for financing, and that's what we see more and more, we put it into the contract, that we have a smoother process by the time that the client gets to the point that they do want to finance, that we have agreed upon everything already. And I think that is a preferential way to go because, no, we don't need finance. We also don't need the hassle. So deal with it early on, please.
So yeah, Steve and John, how do you make Marsha's life easy?
So we opened that finance is dry and boring, I think, and now I'm a hassle. So, I'm only going up. No, look, I think, again, our starting point is that we are lending to our client. So, anything we can get from the build contract is collateral, it's additional comfort. But our starting point is this is a client we want to support, right? These are objectives that we want to support. This is a balance sheet that we want to extend. And so really the build contract is usually signed, right? We're usually getting a pre-baked cake, right? It's done and we can either take that for what it is, we're not going to reopen the negotiation. So that's kind of our starting point is ideally, yes, it's bankable, right? The more protections that the borrower has built in, the more, the stronger that collateral is, and therefore possibly the better the terms are we can give to the client, right? The LTV might be higher, the pricing might be better, covenants might be less rigorous, so the better the terms. And so this is where I think it is a partnership, right? I think the banks and the shipyards are very much aligned in providing a service for the client, right? We all want the client to be happy and to have a good experience, and no one wants a protracted negotiation about, the nuances of who gets to call something in a contract that, the UBO is probably never going to read. So, it's our job to make it a good experience for them. And so I would love to be involved as early as possible. I don't always get to call that, but I think, if we work together in terms of, look, this is what the contract is. This is the bankable language. Most of the shipyards have pretty similar language. And from my standpoint, I'm coming in with the view of, this is a client that I am lending to. The form of collateral I can get, I'll take what I can get, and it might tweak my terms a little bit. But if, the more we can be coordinated and sort of consensual in terms of these discussions, I think the better the client outcome is.
John, is there anything you'd like to add?
Yeah, looking at the name of this panel that I saw, the title, it talks about the rise of construction financing. I think that's a misnomer. I think the rise in demand.
You can blame Rob.
I will blame Rob. I look at the market. Over the last 10 years, the construction market's grown by 10% CAGR a year. It's a large market. Depending on what data source you look at, potentially 15 to 20 billion euros worth of orders and yachts in construction at 30 meters and above. It's a sizable market, and really, I think the demand for financing is there. Unfortunately, the supply is not at the same level. The private banks do their bit of the market. That's fine. They're good at that. It tends to be the larger end, the more kind of bigger, sophisticated, kind of more bespoke build, generally speaking. We saw the data earlier this morning around where the market is in terms of numbers and value. It's your 30 to 60 meters. That's really what drives the market. Okay, the very large builds kind of get they get the headlines, but it's really that main bread and butter part of the business, if I can even call it that, is really what drives the volume in the industry. I think what we've seen from our perspective, we're an arranger and broker, independent of any financial institution. We work with lots and lots of potential funders in this space, and I think we see 12 to 20 transactions a year that come to us in that kind of 30 to 70 meter space looking for construction financing, and there isn't really a home for them. They don't necessarily fit within the private bank requirement. These guys tend to be younger. I think when I first came into this industry, your average age was 60 plus. That's come down considerably over the last 20 years. And these guys are still very much invested in their businesses. Primary. They haven't sold out. They're not sat on lots of cash to be able to invest potentially in a private bank to leverage those investments for a construction loan. So there's that kind of bit of the market that's not really being dealt with, and we know that because we see these guys come into us looking for solutions, and we struggle to find solutions for them that are sensible. I think what we see is, and there are potentially other funders that come into the market. They're not banks. They tend to be private credit, private equity type players. They're nimble. They're more straightforward in terms of to deal with. They're not looking at AUM investment. They're predominantly looking at the collateral of the yacht. The underlying liquidity of the guarantor is obviously of great importance as well. So we do see these deals happening. Admittedly, it's quite sporadic. It's only the odd transaction. I mean, so much so that we're well advanced actually with our own fund. This event's probably come a few weeks early for us, but over the next weeks and months, we hope to be launching our own private financing fund for construction financing for those yachts between the sort of 30 and 70 meters. So watch this space on that.
Oh, that's exciting. So So taking a step back, what we're talking about when we're looking at underwriting these deals, we're looking at credit risk, we're looking at performance risk of the shipyard, we're looking at the potential utilization of the collateral, the yacht itself, and I guess depending on the size, you know, what the market will bear. Like if you have a default, can you get, you know, can you sell it? How do you get out? And I guess with respect to those private equity lenders, that must be very important. And so are they looking really at the larger end of the market or at the, you know, you know, sort of the middle part of the market to sort of the series production side?
I think that's right. I think, you know, the very top end of the market, I think, can be kind of left, if it is from a finance perspective, it's more of a private bank play.
Yeah.
And really the private banks, you know, can get comfortable because they've got a more holistic view of the client. They've got a lot more touch points in terms of, you know, the AUM, whether that be pledged or non-pledged. You know, they've got more collateral coverage rather than just the yacht itself. I think really where, you know, the kind of private credit stepping into that space is really looking at that sort of production, semi-production, I guess, not kind of your large bespoke yachts that really are, you know, significant projects in their own right. They can take a significant amount of time. I think, you know, where we're looking at is really those, you know, those main builders that are building between the sort of 30 and 60 meters, which is their kind of regular turn of yachts. And really, you know, and I think it's the same from a bank's perspective as well, is when they're trying to identify a yard, they're really looking at the performance risk of that yard. You know, how many yachts have they delivered? Have they delivered on time? What is the financial health of that yard? Because performance risk is kind of everything. You want to make sure that you're dealing with a yard that you're pretty convinced is going to deliver and deliver on time. You know, before you even really start looking at the you know, the client makeup, which of course is important, but the yard is really key, and the type of yachts that they're delivering. If something goes wrong, you know, can that yacht be sold quickly out into the market? Of course, the slightly smaller yachts, you know, they're not the less bespoke. They're more akin to, let's call a 5 Series BMW in the car world. You know, there is probably a stronger market to move that yacht on than perhaps a very, very large build where there'll be a decreasing number of people that could actually afford to acquire a boat like that, but even choose to.
And I'm curious, has anyone on this panel been involved in a financing that has been midstream and there needed to be a workout of some kind? And if so, what did that look like? You know, to the extent you can talk about it.
I mean, I've seen a couple of scenarios. They're very, very rare. And really the key driver in those situations is how far during the build has the problem arisen. The nature of the problem is very rarely to do with anything around liquidity of the customer, because he's not paying at that point. The bank has the money. So it's either something that has gone wrong at the shipyard or potentially, in exceptional circumstances, something that has gone very wrong with the UBO. He might have passed away, been sanctioned, this kind of event. And the two scenarios are, if the default comes or the issue comes very late in the day, in my experience, the bank will almost invariably choose to finish the project, because it's a much better outcome for everybody to pay off. If the bank has put in 40%, there's 10% to go at delivery. It's easy. You would certainly put in another 10% to get the 40 back. Where I think it is potentially more difficult is if the issue has arisen early in the build, where potentially the borrower's got 30 or 40% in the project, the builder is still owed a significant amount, and the bank has only put a small proportion in. And at that point, you know, it's just common sense, I suppose. You're not going to put in another 40% to try and get 10% back. But the outcomes really depend on the nature of the securities. We said at the beginning there's this distinction between refund guarantees and title. Some projects have both, but that's fine. But the reality is, if you have a refund guarantee, I expect, you know, you are more likely want to terminate. Of course, the refund guarantee isn't there to just pay you back. It's a refund guarantee against the builder's default, not the buyer's default. So it isn't necessarily the case that what you're going to do is recover whatever you recover after the shipyard has probably finished the build. With a title transfer where the bank has a mortgage over that title, then in a way, I think all parties are that much more invested in seeing the project over the line anyway. But it's important to understand that distinction is not there. The refund guarantee isn't there to secure the debt under the loan. The refund guarantee is there to secure the builder's potential default under the build contract, and whether it responds really is a function of what's happened under the contract and what the issue was.
Okay. Chris, is there anything you'd like to add to that? Particularly, I think before we came out to the panel, we were discussing briefly the events in the Middle East, and apparently there are some yachts in construction in Dubai in that area. And are there things there that you could foresee impacting financing, and would it necessarily result in a bank calling a default straight away, or do you think they'll potentially wait?
Well, I would assume that they would wait and see how the situation plays out. The UAE in particular is a very particular. It's a small construction market, and UAE law is actually very interesting in that they don't allow for registration of the hull under construction, right, or mortgages against that. So it's construction financing there is probably very, very rare. I've never seen a UAE construction financing deal go through. So and as to the other point, one of the initial things that one of your construction documents is construction loan documents is an intercreditor agreement, and it's because the bank and the builder both have as Panos was saying a interest in the hull, and a well negotiated construction financing package will include an intercreditor agreement that the parties agree in advance. What happens if there's a default? What happens if there's a default on the buyer side? What happens if there's a default on the lender side? So usually that's hopefully spelled out in advance to give each so that there's clarity in that unfortunate event.
Okay. There's some interesting questions, and I think the one I'd like to focus on is, does the UBO have to give a personal guarantee? And then is there the ability to make a claim on the personal guarantee if the shipyard goes into administration? I think that's interesting. Do the UBOs backstop you, Marsha?
And I'm not quite sure on this one, actually. Is the personal guarantee, is the parent guarantee, and who gives the guarantee? We, as a company, often give parent guarantees to our buyers, to our clients, as a backstop, what we said against the title. Mm-hmm. And it's a guarantee that goes up to a certain point in the build, because then the title and the, let's say from keel laying onwards, you have sufficient assets to set off the investment. And it depends per contract what happens and what happens when we go into administration. So on average, bank guarantees, I think, for a client give a bigger benefit depending on which shipyard you're looking at. If it's a large shipyard, you have sufficient guarantee in the parent guarantee. If it is a smaller shipyard, I think you'd better go.
Just to clarify, I think there's one point in the question. It's not entirely clear. Are we talking about a parent guarantee or a personal guarantee from the beneficial owner? I'll take both of those very quickly, if I may. A parent guarantee, there are some shipyards, one Dutch shipyard in particular, that is accustomed to giving a guarantee from their parent. And that's a different form, another form of security to the buyer and ultimately to the buyer's lender if they've chosen to finance. And in the ordinary course, you would expect that to be assigned over. But generally, buyers, their banks are looking at securing themselves against the hull or the refund guarantees. The personal guarantee, there we're talking very much, I think, about a personal guarantee from the owner to his bank. I'm sure Marsha would agree, you know, the build contracts very rarely, if ever, have a personal guarantee from the beneficial owner of the buyer to the builder.
Correct.
But they absolutely do have personal guarantees from the buyer's beneficial owner to the bank, because it's just really axiomatic. It's just part of the construct. Any finance package is always going to be backstopped.
And so I think this is it. They're asking whether that personal guarantee covers shipyard risk.
Well, it would, for the lender, it would cover the risk if, in fact, the shipyard has gone into administration, the project has somehow failed, and the bank has advanced a certain proportion of money and is unable to get that money back through the insolvency. If it becomes an insolvency, ultimately the guarantee will cover all of the liability to the lender incurred under the loan.
Now, I must say that a personal guarantee by a UBO to a builder would also be very nice.
Wouldn't it? Wearing an owner's hat for a minute, Marsha, I think the market doesn't go that way. I think it's...
Not yet.
Yeah, not yet. Well, maybe.
And it looks like Mark Burgess at BNP wants to know whether having a bank involved makes your life better. Marsha.
Well, I think it ties in with my comment just now. If you look at first-time customers, especially for us at Feadship, we vet our clients quite significantly, and many of them are well-known people with a public net worth. So you have that kind of guarantee that you know who you're dealing with. I can imagine for smaller shipyards, clients who you are not that well-known, where you don't have the information, that having a bank backing them up absolutely is a good thing for that builder. But then again, I do think we are now at a point where the bank guarantees, the parent guarantees from the builder to the owner are pretty standard. I do really think that we're going to go into a situation where the reverse will also be happening, because it is becoming more and more professional, both sides, and I think that will be a part of it as well.
Chris, you wanted to...
Yeah, I think that it's very important, again, to look at the market segments here. I think that when you have Panos and Marsha involved in a transaction, they foresee all of the potential risks. They know what's coming down the line. When you're in the lower, the smaller, middle market segment, a lot of those borrowers have not, they may not have hired Panos to look at their contract in advance, which means that you, as the attorney for the bank who's coming in, you're essentially looking at a contract that's never been reviewed by a yacht lawyer in the first place. It was just signed, right? Which so then your job is to protect the bank, which involves oftentimes trying to at least obtain additional protections for the bank, which then provides additional protections for the borrower as well. So I think certainly in the middle market there's a lot more having construction financing involved does yield a lot more protection for the buyer.
And with less than 1 minute to go, crypto, yes or no? Anyone use it?
We don't.
Not for financing.
Alison wants a microphone.
Do you want this one, Alison? This is the only one that worked. Shout out.
No, just a quick comment that one factor which hasn't been mentioned is the flag, the prediction that the choice of flag is financier. And I think it's been sort of mentioned important that is as a factor. Since last year, Malta also introduced a tweak to the registration of mortgages under construction, whereas now 2 owners can register directly. And there is also a tremendous benefit under Maltese law, which has made us the largest flag in Europe, where a vessel can be sold under the self-help remedy of the financier to sell regardless of territoriality in case there is a default by the borrower. So I just wanted to...
I'll take that one very briefly, if I may. Alison, I think construction mortgages, you know, you could talk for a very long time about them, but in essence it comes down to whether or not they give you security in the event of a insolvency or administration of the builder. And in that context, I think the general view is that you need to have registered something in the jurisdiction of the builder. Why? Because the receiver of the shipyard is probably not going to consider themselves bound by a parallel registration outside their own jurisdiction. So whilst registering under construction in Malta, in Cayman, the other registries that do it, certainly has a value, it's got a probative value, it shows you that, you know, that's what the parties thought had happened, that it was the buyer's title. It is not necessarily going to hold up in the face of a yard insolvency. As between the buyer and his bank, it has a real value, but I think our experience is you've got to have registered locally, and then Germany, Holland, Italy, dare I say Turkey, have a different system, and then you've really got to understand what you've done. So I think they are valuable, but they have to be viewed in the context of that primary risk of a potential yard insolvency or creditor process of some description.
So when there is the transfer of title in stages, then of course, as you said, you have to mesh the entire finance.
Exactly.
And if anyone wants to see this conversation continue with gloves, the coffee break is now.
Come on, Eric.
All right, thanks everyone.
Thanks very much.